Heidrea for Heroes strives each day to give back to our deserving military veterans by assisting them through challenges and transitions in civilian life. A registered nonprofit organization based in Plymouth, we provide support services to veterans who need a helping hand from throughout southeastern Massachusetts. We offer a range of services including adaptive home renovations, vehicle modifications, specialized mobility equipment, qualified home repairs, and custom veteran and family support. If you or someone you know is a veteran in need of assistance, please contact us to fill out an application. We also offer workforce readiness programs for veterans, including a Success Readiness series, which features seminars and webinars on job seeking and life skills, as well as Incline Corps, a unique monthly fitness program exclusively for veterans. To learn more about Heidrea for Heroes or our programs, to watch a webinar, or to make a donation to support our work, please visit our website at www.heidreaforheroes.org. That's HEIDREA, the number 4, HEROES.org. Our veterans sacrificed a great deal to serve our country. It is our great honor to give back by lending a helping hand.
It's a pleasure to be here. As she mentioned, I've been a realtor for about 13 years, and I say veterans are probably about at least 85% of my business. I'm very fortunate. It's a niche that kind of found me, and it's just been fabulous because of the people that I meet. And a lot of people are young. They're all ages, but a lot of people just coming back from duty sometimes, and they're just starting out, maybe like yourselves. And it's just really, really rewarding to see everybody doing everything right from the beginning. So it's just really been awesome. So what we're going to talk about tonight, we're going to do an overview of the home buying process. Basically, we're going to concentrate on the home buying process itself more than the VA loans themselves, not the loan aspect of it, although we'll be touching on that. But essentially, we're going to be talking about how to buy a home smart in general, and also the specific things that relate to a VA loan versus another kind of financing. Okay, there's a lot of benefits to the VA loans. The three major ones, though, are that there's no down payment required, although you can put one down if you want. We can talk about what those situations, why they can occur sometimes. There's no private mortgage insurance, which is about 0.5 to 1% of the loan on top of your mortgage payment every month. So that's a really huge benefit. If you put less than 20% down on a home, you're going to have private mortgage insurance, and that's just so that really reduces your affordability. Because just like when you're buying a car, you're really buying on payment. You're not necessarily looking at the car was $35,000, you're saying how much is my monthly payment. And it's the same thing with a house. And because interest rates are so low right now, you can afford to buy so much more house than you can when the interest rates go up. So that private mortgage insurance, if you have to factor that in, then it means you can buy a less house because your payment will go up because you have that private mortgage insurance on there. So that's a really huge part of the benefit of a VA loan. They also tend to have lower interest rates, so you know you're not going to pay more than you need to on your interest rate. And then they also can be flexible on your credit standards. So for example, for a veteran, VA loan, you can have a credit score as low as 620, whereas other organizations probably want one to be closer to 640 in order to get 100% financing. And the other thing that's not even on here is that right now 100% financing products are really very rare. There's still a thing called the USDA, but that's 100% financing. But again, you still have you're going to have a funding fee like to pay for the mortgage insurance. And the other thing about them is they've changed the demographics so that you have to now live in a town. I think it has under less than 10,000 people. And so Plymouth used to be a USDA, and now it's not because we have like almost 60,000 people. So that kind of came off the table. So as far as being able to buy a home with 100% financing, there aren't a lot of options out there right now, and that's why the VA program is so great. So those are the major things that make a VA loan so attractive. And you can use it more than once. A lot of people ask me that. Well, gee, I already used my VA loan. Can I use it again? And the answer is yes, you can. As long as you pay it off, and then use it to buy use your entitlement again. There are some restrictions on them where you can't, and that might be covered a little bit later, but you can't use it to buy a second home for example, or an investment property. But there are also times when you can actually keep your existing home and rent it out if special circumstances apply. For example, if you're being relocated to a different state, and or if you definitely outgrew, your family grew, and you got a one-bedroom house and now you need 3 bedrooms, and you need to make a transition, they will let you sometimes, keep the same house while you're buying another one, either sell it later or rent it. It's a little more complicated if you want to do that. It's a lot cleaner, obviously, if you're going to be selling it and paying off your loan. But just to know that you can use it more than one time. Any questions on any of that so far? Okay. So here's one or more of the following conditions: that you've served 90 consecutive days of service during wartime, or, these are all or, you've served 181 days of service during peacetime, or you have more than 6 years of service in the National Guard or the Reserves, and or you're the spouse of a service member who died in the line of duty or as a result of service-connected disability. Okay. We kind of covered that a minute ago. You must be a primary residence. It can be a single family or a condo or a townhouse or a duplex, which is a 3 or 4 plex or more also. And it says you avoid unique property. So things like a log cabin or, or a particularly avant-garde, maybe contemporary home that's really unique, those types of things. But again, in our area, we don't tend to find so much of that sort of a home. It's going to be more, in our area at least, it's going to be more capes and garrisons and colonials and salt boxes.
Mini houses are off the table. Right?
Right. So now this is where it can be a little bit, it's really good to have a realtor that knows about VA loans. Whenever I'm working with a VA buyer, the first thing I do when I want to see a house is I call the other agent. We'll talk about different kinds of agents later on, but I'm a buyer's agent in this case, and there's a seller's agent on the other side representing the seller, which we'll get into. But the point is, I always ask them, will it pass a VA appraisal? So VA wants you to buy a home that's good for you. They're trying to protect you, which is obviously the right thing to do. So they don't want you to buy a home that has certain issues. For example, any kind of peeling paint on the outside of the house, any kind of rot. Sometimes the bottoms of rake boards will have some rot where water damage got if the gutters weren't applied right, or maybe sometimes the bottom of a wood door might be wicking up moisture and it's rotting there. Window trim. So they care about rot, peeling paint, a roof that doesn't have any, that has at least 3 to 5 years worth of wear on it ideally. If they see curling shingles and things that are missing and it looks like it's just had it, they could fail it for that reason. And then, of course, anything structural. They care about that. And those are all common sense things anyway. So in some cases, like if it's peeling paint or rot, it's a case-by-case basis, but if the seller has some money, oftentimes they'll work with us to just fix it up so that it will pass the VA appraisal. And just so you know too, it doesn't mean a VA loan is onerous in any way, because an FHA, another government-backed loan, is very, very similar. They also don't want peeling paint, they also don't want rot. So, and the other thing that a VA loan looks for are railings. They want to have railings on almost anything that's over a certain number of steps has to have railings. A lot of times you'll find those missing. That's really easy to fix. And then the last thing on it is perhaps the most, I think, unusual thing about it is that they don't want you to buy on a private road. So, which sounds kind of odd. In Plymouth and in Bourne, and a lot of places on the Cape, there can be a lot of private roads. So a lot of times I'll call a realtor and I'll say, is it a public road? Because I'll have it listed public in the MLS sheet. And they'll say, yeah, it is, because the town plows and they pick up the trash. Well, I found out the hard way that isn't what makes it a public road. There are a lot of private roads that fit that description. What makes it a public road is if there is a written, ongoing agreement in writing for road maintenance, ongoing maintenance. So if there's a pothole, if there's a sinkhole opens up, who's going to pay for it? So I always make sure that it's not on a private road. In fact, I had one today. A veteran wanted to buy a property on the Cape. I'll look at one, and I did some research, and it's on a private road, and that's not going to work. So those are things that are good to know up front before you waste a lot of time getting your heart set on a house, or spending a lot of time looking at homes and then finding out that they may not be something that's going to suit your needs. Any questions on any of that? Okay. Okay, now water supply. Another thing that the VA makes you do is to, and again, you'd want to do it anyway. If you had a well water versus city water, they want you to have a well water test. to see if it's healthy. You know, they look for things like nitrate levels, they look for things like a pH level, things like that. You know, a lot of the times they're fine, sometimes they're not. Sometimes it's an easy fix. If the seller has a filtration system, they can just have a service call to that and have that fixed. It can be a little more complicated if it's not. But a water test is something you're definitely going to want to have anyway. It's a little extra cost on top of your home inspection, but it's something the VA requires, and it's something that's good for you to have, because you want to know. That's really important, is your water. Okay. So obviously, you know, crawl spaces, they want things pretty much free of debris, and no excessive moisture, and ventilation. They're kind of self-explanatory, and of course it must have electricity. They also want to make sure that the plumbing is all intact. So for example, if a house is missing a stove, you need to put a stove in before closing, because you have to have a stove. You have to make sure all the plumbing is working. Sometimes it could be one full working bathroom, but the other bathroom might be, say, roughed in, and that won't necessarily pass because it's not a complete bathroom. So these are just some things to look out for. And again, it's all about having information up front so that when you go to buy your home, you don't spend time on something that may not be suitable for you. So, all right, so now I touched on a minute ago a little bit on a buyer's agent versus a seller's agent. Anybody familiar with the two different kinds of agency? Okay, so most people don't know that, and that's why a lot of people wind up calling the person whose name is on the sign. Now, the person whose name is on the sign on the front yard is working for the seller. They're hired by the seller to represent their interests. It's called a fiduciary relationship, which means that they're a client versus a customer. They have to put the seller's interests above their own, and their job is to get the very highest price for the property that they can. That is what they're being hired to do. So, and that's good, because sellers need representation and protection as well. It's the biggest asset they have, and of course they want to maximize how much they can get for their asset. However, you as a buyer have the opposite goals. You want to get the lowest price and the best terms. And so now there's buyer agency. Believe it or not, there wasn't any buyer agency. I think it's like the 80s, I want to say, when they finally came out with it. Everybody worked for the seller, and nobody worked for the buyer, which is kind of crazy. It's kind of like going to court and you're working with one attorney for the prosecution and the defense at the same time, right? They have a competing interest. It's clearly a conflict of interest. So by having a buyer's agent, you have an expert in your corner. Obviously, we know all about all the properties that are on the market. You have an advocate during negotiations, because a buyer agent's goal is to get you the property for the lowest price and the best terms possible. So it evens the playing field, basically, is what it does. And we work with it with no extra charge. So the nice thing about buyer agency is that agents get paid out of the proceeds of the sale on the seller's side. So if a house is $250,000 and that's what you negotiate, your price is $250,000. However, the seller has got to turn around and pay 2 real estate commissions out of that $250,000 that's built into the price. So one of it goes to the seller's agent and the other half goes to the buyer's agent. And that's pretty much how that works generally. Okay, so settlement fees. So before I get to that, I want to talk a little bit about the process. So the first thing is that you're going to be getting access to all the homes that are for sale, and you're going to find the home that you want. And then after that, you're going to be making an offer as the very first step on your home buying process, is to make an offer. Once your offer is accepted, then you go to what's called a purchase and sales agreement, which formalizes the offer. Okay, and I'm going to touch on this a little bit more later, but I just want to kind of go over because I'm leading up to settlement fees. And then once your purchase and sales agreement is signed, then that goes to your lender. They hire the appraisal, and then we actually go through our mortgage commitment process, and then we get to the closing table, which we'll talk about a little bit later, but I just kind of wanted to cover that. So settlement fees are, you've already heard the term closing costs. So when you go to buy a car, for example, it's not just the car. You have to get, registration. You got to get a plate. You have excise tax, things that you have to pay in order to the purchase of the car. It's the same thing with a house. So with a house, you have these things called settlement fees, and inside the settlement fees are your closing costs themselves. So, for example, settlement fees are anything needed to settle the loan, and they include things that you would often be paying anyway, but you're paying them up front. So, for example, they could include So property taxes, they could include, depending on what time of the month you close, they include a year's worth of your homeowner's insurance. They include a month's worth of mortgage interest, because in the beginning, your home loan is going to be almost all, your payment is going to be almost all interest. The bank gets their money first, and then they start paying down your principal. So when you close on your loan, the very first, for the first 8 years or more, most of your payment is going to go towards interest and not to paying down the principal. So when you have your settlement fees, they take that out up front as well. The nice news is, though, if you close like after the 5th of the month, then you won't be having a mortgage payment for like another 40 days, 30 to 45 days. Okay, so you get to have a little bit of a break there because you're paying it up front. So those are things that are needed. Closing costs are things like title insurance. The lender has to have title insurance. So if anything later on, they're going to do a title rundown when you buy your home. But let's say that later on it turns out there was a problem with the title. Then the title insurance protects the bank and it pays them for the value of the loan, so the bank doesn't lose their money. Okay. So the title insurance will be in these closing costs and settlement fees. The other thing that's in there is a title insurance policy for the buyer. That is entirely voluntary, but it's good for you to have. The reason the lender wants it is because they know things can go wrong sometime. And if something did go wrong, the lender would get paid by the lender's title insurance they make you pay for, but you don't have any protection. So by having your own title insurance policy, you are protected as well. So these are all things that are all included in this big lump sum that you pay on top of your actual purchase price, okay? And then you have mortgage origination fees, you have underwriting fees, you have the attorney fees. So these are all things. So on an average, you might be wondering, what do these things cost? It depends on the size of the cost of your home. The more expensive the home, then the higher the closing costs and settlement fees are. But on an average house of, say, $250,000, they're probably going to be around, I don't know, between $6,000 and $7,500, depending on your lender and your taxes in your town. You'll be prepaying some taxes, I mentioned. So they vary, but you'll know that before closing. Okay. Any questions on any of that? Because that's kind of a lot of information. Everybody good on that? Okay. Okay, now, this is a classic question, and people get confused about this all the time, and rightfully so. Who really pays the closing costs? So a buyer will say to me, well, I heard that the seller can pay my closing costs for me. Well, they can, and we often have it structured in exactly that way, but you're really still paying them. And the reason is, like this example here, let's say the mortgage is $250,000, or the list price is, and it's $7,500 in settlement fees. So scenario one, you build that on top of your mortgage. So now your mortgage is $257,500. Or you get a mortgage for $250,000 and you bring a check for $7,500 to the closing. Not everybody has that kind of money. Some people do. But with the cost of money being so inexpensive today, over the life of that loan, that's pennies. So you're better off reserving your cash if you can and just financing it into the loan. Any questions on any of that? Okay. Okay. So let's go over home inspections a little bit, because a home inspection is not an appraisal. Those are two separate things. So let's say we have our offer accepted, and then we're waiting to get the purchase and sales agreement done. In between, you want to have a home inspection. Now, you don't have to have one, but you absolutely want to have one, because it will tell you everything that's wrong with the house. And even new houses will still have a punch list to some extent. But all homes that are resale homes are usually going to have some kind of issues. You get real lucky sometimes, and the sellers just took care of everything, and pride of ownership, everything's perfect. But in most cases, the seller's just as surprised as you are when you get the home inspection report that these things are wrong. So a home inspection, we always recommend getting an ASHI certified home inspector. That stands for American Society of Home Inspectors. And the reason that's important, believe it or not, there are no standards, in Massachusetts anyway, that a home inspector has to adhere to. So they're all over the place. I've had guys show up with a notebook. I've had them show up with a checklist on a multi-part form. The ones that I like to use, and only a buyer agent, by the way, can recommend a home inspector, because we're on the same team. A seller's agent cannot, by law, recommend one for obvious reasons. They're on the other side. But the ones that I use or recommend, they always use computerized reports and a lot of digital photos. So you get this whole report, multi-page report, showing everything with call-outs, with red lines, and explanations of what's wrong and what have you. So those are really important. So once we get that home inspection report, you own it, you've paid for it, what does it cost? And by the way, there are a few out-of-pocket expenses that are necessary. Again, people think I'm buying 100% down, I don't have to have any money at all. That's not true, unfortunately. We wish it were, but you have a couple out-of-pocket expenses. The biggest one is really going to be the home inspection. It costs between $400 and $525, depending on the size of the home. The bigger the home, obviously, more expensive it is.
The fire safety inspection, as far as the smoke and CO detectors, does that come out of the seller's bucket or the buyer's bucket?
It does, yep, because what happens is part of the thing the seller has to provide is a smoke certificate. You cannot close without one, and that costs, you have to go to to the fire station, pay $50 up front, and then put all the smokes and carbons in. If they're hardwired, they all have to be the same. They all have to speak to each other. So, yeah, you're right, that's how that works, okay? So that's it on the home inspections, I think, for now. I know what I was going to say. So you own the report, so it costs a few $100s. So I don't send the report to the agent generally, but what I will do is take excerpts, screenshots of the ones that pertain to you, that we're going to go back and ask for repairs on. We don't always, ask for a lot of repairs. It really depends on what's wrong. Try to stick to the big stuff. It's not unusual for a home inspection report to turn up 37, 43 things that are wrong with a house. Most of them are pretty small. A lot of times, the polarity in a plug will be reversed, or I don't know, things like that. You want to look for things that really matter. A water heater that's about to go, they usually last about, anywhere between 11 and 13 years. You might see that it's all rusty. Maybe there's some pressure valves that are ready to go. Things like that, that you tend to stick with the big stuff. The other thing that a home inspection turns up a lot of times in our area is mold. It's very, very common. It's extremely common on the Cape. That is something we always go back for and ask the seller to pay for it. The thing to remember about going back to the seller is that they don't have to fix anything. They can say no, and you can decide whether or not you're okay with that, or if you're going to come to split the difference on a cost or something like that, or just let it go. That's just something that's just part of the negotiation process. Okay. So mold was a big one. The other thing that the VA makes you get, and again, you're going to want it, is a pest inspection. So part of the way the VA works is that they make it so that the home inspector must not charge you for the pest inspection portion of your home inspection. So he'll go around with his stick and he'll look at the sill and make sure it's not punky, make sure it's solid everywhere. And he'll also look for signs of past activity, like shelter tubes. So a lot of times, and this happens like almost all the time, they will find evidence of past activity, but no current activity. So what generally happens then is that the loan officer will often want a pest inspector, a real pest inspector, then to go out, a pest inspection company that does that for a living, to go out and see, is it really okay the way it is there nothing active? If they mention that there's damage in the report, then they're going to want that damage repaired. And so again, that's usually when we're going to go back to the seller. So again, sticking to the big stuff that really matters. If they have to assist or a joist, or they have to, to replace a piece of board or something like that, and maybe sometimes even have it treated. We'll ask the seller to pay for the treatment. So those are the big things that we tend to look for. So the VA requires you to have a pest inspection. They require you to have a well water test. Those are the two quote-unquote extra tests that a VA loan requires you to have. And so now, this is important. So a home inspection is not the same thing as an appraisal. So remember I was talking earlier about rot and peeling paint and roofs. The inspector is going to tell you, yes, these things are here if they weren't already obvious to you, but he's not going to say is that good or bad in terms of is the home going to be approved by the VA. That's what the appraisal is for. So going back to the order of events, first we have our offer, then we have our home inspection within 10 days. Then meanwhile, the purchase and sales agreement is being drawn up. And then after the purchase and sales agreement is fully signed by everybody, both parties, it's called a fully executed copy. That's going to go to the lender. Once the lender has that, that's when they order the appraisal. And that's with and these are VA appraisers that go out. So there's general appraisers and then there's VA appraisers. And there's just so many of them. Believe it or not, there's not enough of them. And so we get backed up sometimes where they get so behind, especially in the spring market like right now. They're supposed to have 10 days to get out to the property and do the report and get it back. 10 business days. And I've got one now, it's on day 11, and they told me, we'll get to it. And that was the answer that I got. So, they can get really busy. So they're looking for those things that we talked about. Is there peeling paint? Is there any rot? Are there railings in place? Do they see anything unusual they think is going to be detrimental to the property? So they're looking for that, as well as the general value of the home. A general straight appraiser who's not VA is looking, does it comp out? Is what you're paying for the home match up with other comparable homes have sold for? And the bank, of course, wants to know, because they want to know, am I lending you money on something that's worth what I'm lending you for? So that's what the appraisal is for. So once that appraisal is done, then it goes into underwriting at that point, final underwriting. And then it goes through the process, and very often at that point they'll come back to you and they'll ask you for things that, like another bank statement, they'll ask you, gee, what's this deposit on your bank statement? Can you explain where that came from? You had your credit pulled, what was that for? And things like that. And let's talk about that for just a minute, since we're on that subject. People think once they're pre-approved that they're golden, and that's not the case. What happens is, and I've had this happen not many times, but enough times, where someone will get pre-approved and they'll go out in between getting pre-approved and buying the home and closing on it, they'll go buy something, a truck, motorcycle, furniture, something like that. And that's a bad idea, because it can totally upset your back end ratios. Because when the bank pre-approved you, it was based on you having a certain number of assets, a certain number of income, and a certain ratio. Now, if you have a really phenomenal credit score in the 800s and you make a ton of money, it may not be such an issue. But if you're like a lot of first-time buyers, you might be in that lower credit score rating. You might be close to the edge, and if you make a purchase or do something like that that messes up your credit, it can put you under the 620, and then you can't buy the house. And even though you've been through everything, the offer, the pre-nest, the appraisal, everything, you paid for all of that out of pocket, the inspection, and you can't buy the house. So it's really, I have that talk with all of my buyers to really make sure they understand that because the point is that they're going to pull your credit again just before closing. That was the point I was trying to make. So they pull it in the beginning when they're qualifying you, and then they pull it again just before closing. They're also going to check your employment status, make sure that hasn't changed. And the other thing is things that affect your credit negatively is opening up a credit line. They look at that as the ability to abuse. So even though you may not be going to abuse it, they could push you over the edge, and you think you have too many credit lines. And credit inquiries also on your credit report will actually reduce your credit score. It depends what the inquiry was for. There's soft inquiries and hard inquiries. But if you're opening up a store credit card, for example, that's not good, because they're looking at, again, potential to abuse. But if you're shopping for rate on a mortgage, then it's a little less of an onerous hit. Go ahead.
What about those, like you said, like Credit Karma and like all those things to check your credit, and it's so easy to just go online, and I think that's more like a soft pull on it.
It is.
But is
yeah.
it still negative?
It can be. I wouldn't do it once. I mean, once you're working with a loan officer, you don't really need to do it again. The other thing is just be really scrupulous with your credit during this process. Don't obviously, no late payments, things like that. Make sure that. Go ahead.
I'm sorry. For instance, so I pay, whatever the minimal fee is for the Experian thing. It's like a credit tracker. It helps me, because I've been rebuilding and stuff like that. Is that bad for me to be doing? I'm not like pulling a credit report, but it tells me. It
gives them a number.
Yeah.
It gives me a number here and there, and it tells me if I'm going up or down or how I'm doing. Like, is that something I should be?
I think that's probably fine. I mean, just to be sure, you should probably want to run it by the loan officer you speak with. But it sounds to me that that's just simply a credit monitoring thing, as opposed to, right. You're not opening new credit lines. That's what they care about. You're opening new credit lines. And then the last thing is how about if you don't have enough credit? Believe it or not, no credit is just as bad credit, because you don't have the credit history for them to go by. So sometimes I'll be talking to people really early in the process, VA or otherwise, and they say, well, they may have gone through a tough time. They might have had some credit card problems. They say, I don't have any credit cards at all. I don't use them. And it's like, then you've got no credit lines. So you actually have to open one, buy groceries with it, pay it off every month, just to establish that for several month period. So sometimes it's getting a gas card or things like that to build your credit. Okay, so that's important. Yes.
On that, about looking at your credit, how many years do they go back?
How many years do they go back? Well, they go back, it depends. I think they go back a few years, but if you've had a bad credit event, for example, a foreclosure is like 7 years, and a bankruptcy, I want to say, is like 3 to 5. I'm not sure exactly, but they're going to go back a ways and just see what your overall history is, because they're looking for ability to pay and how credit worthy are you. And that's really what it's about. That's why they penalize you so badly if you have a foreclosure, because it shows that even though so many people got caught up in the housing bubble, I mean, so many good people got really hurt. People that, for no fault of their own, And which might be a good time to talk for just a second, bounce around a little bit, but when you go in to buy a home, you're going to see some, you ever hear the term short sale? Okay, or underwater or upside down? Those are all the same thing, meaning that people owe more on their mortgage than they can sell it for. And if you bought at the top of the market in 2004 or 5 or 6, and even part of 7, things were just rocking and rolling, and people had adjustable rates, and they were getting 100% financing, and they wound up in some bad mortgage products. So what happened to a lot of people, a lot of people that bought then are still upside down, but that's okay because they can still make their mortgage payments. What happens is if somebody has an event in their life they can't help, they lose a job, they get a divorce, or they have a medical issue, and all of a sudden the money's not there. So what happens? So what happens then is a short sale is when they go to the bank and say, look, I'm going to lose the house. I'm either going to need to sell it short. Let's say the house is worth $250, but your mortgage is $300. I need to sell it $50,000 short, and the bank will sometimes work with them to let them do that. But then they will issue them a 1099 for the income that they got. No, the difference will be taxed as ordinary income on your next tax return. But it's better than a foreclosure. Because if you get a foreclosure, then obviously, your credit report is going to be a lot more damaged. With a short sale, it'll say settled, and you can buy a home again with another 18 to 24 months as long as you have 20% down in most cases. But for a foreclosure, it's a lot more difficult. So that's actually a short sale is called a pre-foreclosure home, which leads me to another important topic. People will say, gee, can I buy a foreclosure property? The answer is yes, you can, as long as it's already post-foreclosure. A lot of people will see auction sites and they'll say, you cannot buy a VA in particular, but these aren't good for first-time buyers either to go to an auction because that house is coming with every kind of what and all. If it's got liens against it, water bills, taxes, you usually can't get inside it because you have a hostile tenant, usually the owner who's not real happy. So, you're buying it blind. You have to usually put $5,000 to $10,000 down just to bid on it, and then you got to close it within 30 days, and if you don't, you lose your earnest money. So those are great for investors. But let's say that they held an auction for a house and it didn't sell. The investors show up, the bank has a reserve. They want too much money for it. So the investors say, I'm not going to buy that, I can't make any money on it. So then what happens is the bank will buy it back, and they will list it with a regular real estate agent called an REO broker, real estate owned, and then they'll clean it all up, they'll take care of all the back liens, the back taxes and everything, and then they'll list it with a real estate broker, and it will be sold like any other MLS property. That is correct. You can absolutely do that. However, there is a little catch. With a short sale and with a post-foreclosure property, the seller had no money, so guess what? There's usually going to be delayed maintenance, which can be, guess what, things that could be a problem for the VA. So it's always case-by-case basis. So. But I've sold plenty of them to veterans and other people as well.
I mean, if you find a perfect scenario, you find a perfect scenario.
Exactly, and the key is to have one that has the right things wrong with it. What I say, paint and paper. Yeah. Stuff that's totally outdated, but you can live with it for a while you're fixing it up and you're willing to put the sweat equity into it. But it's not anything that's so wrong that's going to trigger a problem with the VA appraisal. Okay. Any questions on any of that? Okay. Okay, so we talked about home inspections already a little bit, but I had a home inspector tell me once, my job isn't to find anything good about the house, is to find every single problem it could possibly have. And 2 reasons why deals fall apart. Number 1 is financing, because people either don't get pre-approved or they mess up their credit on the way, or home inspections. Especially with a first-time buyer, a home inspector can scare the bejesus out of a home buyer without meaning to, because it looks scary and you're spending all this money and all these things are wrong with the house. But again, that's why a good buyer's agent can help you walk you through, and with the help of the home inspector, to say these are the things you really care about, these are the things you might want to fix later on. Okay, but they look at everything. So they look at all the structural elements, the plumbing, the wiring, the heating, and the cooling. Anything that they can observe. They can't, they don't do things they can't see, obviously, like behind walls and things like that. But they'll go up in the attic, and that's where you see the mold. Now, also on the mold, they have to say what appears to be mold is in the attic. It'll be like a black on the sheathing, and it may not even be, it may not even be toxic mold, but you have to take the precaution and assume that it may be. You can have an expensive test done, but you're better off just asking the seller to treat it. For an attic, it's usually going to cost around $1,800, $1,200 to $1,800 roughly, to treat attic mold, and then it's done. So, like I said, heating system, central air, plumbing, electrical. They'll turn all the water on in the house at the same time to see how the water pressure is. They'll also see, you know, what is the water temperature? Is it too hot? Is it not hot enough? Things like that. The roof, obviously, the attic, insulation. They'll look at the condition of the walls, ceilings, floors, obviously windows, doors, and foundations, and the structural components. So, and the VA appraisal, like a kind of, this might be a repeat slide, but it's an assessment of the property's value and condition by an independent VA appraiser. And by the way, that's important too. Your loan officer does not get to order he doesn't get to choose the appraiser, or even put it into a lottery. The VA themselves puts it out for the appraiser. So it actually comes directly from the VA itself, not your loan officer. I think we already got that. Okay. The VA wants to ensure that homes are safe, structurally sound, free of any health hazards, and in pursuit of that goal, the VA appraiser conducts a health and safety check on the things we just talked about. Key focus is price, which we talked about already, and then the roofing. Is it adequate? Does it have like at least lenders usually have a number in mind, like 3 to 5 years. Okay. And then property access. All properties purchased with VI finance need to have safe access from the street. Private driveways are permanent easements to allow entry, and we talked a little bit about how private roads can be a problem. So appraisal, what does it cost? Oh, go ahead.
Question on that slide. Mm-hmm. It said a private roadway on. Go back.
Right.
No, next one.
Yeah, I know. I'm sorry.
Yeah.
There. Okay.
It says homes on shared or private roadways, but you said at the very beginning.
Right. Either private, it has a private driveway or a permanent they're saying a private driveway, meaning not a private road, a driveway. They don't want you to necessarily have a shared driveway, but they will let you have a permanent easement that's written into the deed to access your property. They just want to make sure you're not cut off ever by somebody else.
So if there's like a house built here and a house here, and this is your house, you have to go by.
And it has to be in the deed that you can do that, right? So the other person can't say you can't get to your house. That's what they're talking about. Okay, that's a good question. Okay. Appraisals, they cost about $425. And once the appraisal is submitted, it's reviewed by the lender's underwriting department. And they make sure that they agree with the appraisal and the numbers. And then they issue what's called a notice of value. And that's when we're pretty done to you got your mortgage commitment. And by the way, since we're talking about that real quick, first you have your pre-approval, and then you have your commitment at the very end. Your mortgage commitment is going to come maybe just a few weeks before you actually close, after it's gone through underwriting and all the other things we talked about in advance. So they issue that notice of value. And then there's this thing called a VA amendment to contract that must accompany every purchase and sales agreement that a VA does. And the reason is, what that says is if the home does not appraise, you are not obligated to buy it. You can if you wish, but you don't have to. And if the agent, in normal circumstances, if the agent doesn't write that into the offer, subject to appraising at full purchase price or above, then the seller could technically come back and say, well, you know, it didn't appraise, but that's not my fault. You know, I have your earnest money, and I'm going to keep it. You know, it may not happen that way, but you know, it can. So by the VA saying that, you putting in writing and make the seller sign it, if it doesn't appraise, you're out of the deal. Okay, which I should also touch on now, probably the other reasons that you have protection and contingencies. A buyer agent's going to write contingencies or escape clauses into your offers for you. The first one is going to be subject to a mortgage. So you have to be able to get your mortgage. If you deny it on the mortgage, then you're out of the deal. Subject to a clear Title V if it's not on public sewer, and you have to have a Title V inspection, which the seller has to pay for, by the way, the Title V. And we put it subject to maybe sometimes subject to the seller paying the buyer's closing costs or crediting him back a certain amount of money. So let's say that you had your home inspection. I will write that up on the offer subject to a satisfactory home inspection. So if the home inspection turns up things you just are not happy with and you just cannot come to an agreement with the seller on a repair, then you can say, you know what, it wasn't satisfactory. And then you can walk away from the deal that way. Okay? And of course the same thing, clear Title V. That's something the seller has to pay for. It can cost, the average of a Title V inspection is about $550 to $650, give or take, depending. And that's something the seller has got to provide a clear Title V certificate in order to close. Now, when you're out looking at property, and again, your buyer agent will explain this to you when you're meeting with the initial buyer consultation, but you want to stay away from properties that say septic is buyer's responsibility. You don't want that, because that means that, number one, you got to pay for the inspection, and if it turns anything up, then you're out that money because you don't have the money to pay for a whole new septic system or a repair. Okay, so you want to avoid things like that. Let's just keep going here and I'll get back. Final steps to closing. Final credit review, which we kind of touched on a minute ago. They're going to pull your credit again. And then the settlement statement. That's something that's going to be generated by the lender and the attorney. And that was going to break down all your costs, the cost to the buyer, the cost to the seller. And down the bottom is the number that you're paying or the number that the seller's getting, money that they're either going to be getting back because they're selling at a profit, or money they're bringing to the table because they're short and they had the money to make up the difference. Okay, and then the final walkthrough is usually done the night before, sometimes the morning of, where we actually go through the property one more time while it's empty, and we make sure that everything looks exactly like it did the last time you saw it. That there's no holes in the walls, that there's no plumbing missing, that they didn't take a chandelier that was supposed to be left there, and things like that. Okay, things that are left in the home, by the way, typically anything that's built in is considered real property as opposed to personal property. So stoves are built in, refrigerators are not. A lot of times, if it's excluded in the listing agreement, it'll say what appliances are included, and it'll include things usually like obviously the stove, sometimes the microwave, and a lot of times the refrigerator won't be included. You can write it into the offer and say, we'd like you to leave the refrigerator if we pay this much money, but it's not obligated to do that. But anything that's attached, so light fixtures that are attached to the ceiling, even curtain rods, those are supposed to be all included and left behind unless they're specifically excluded either in a listing sheet or negotiation afterwards. Generally in a listing sheet, sometimes somebody will have something sentimental value, or they'll have a chandelier that they want to take with them, and they'll say, does not include chandelier, or does not include washer, dryer, things like that. Okay, so that's the final walkthrough thing. What to bring to the closing, your license, certified funds for closing costs if you're bringing them. So they don't want a personal check. So let's say that you were going to, let's say that you only, you were only able to negotiate $5,000 in closing costs included, and you needed to bring $2,000 or $2,500 to the table. You would bring a bank check for that amount, and you're generally going to be making that out to to yourself, and then endorse it over to the closing attorney. And the reason you do that is because if anything went wrong at the last minute, the check's made out to you and not to somebody else. So you don't have to go through that. And then your checkbook, it's rare that you need that, but it's always good to have it for incidentals if something's one way or the other on the HUD, maybe $50, $100. Or if you might have negotiated a private side agreement with the seller on maybe leaving some furniture behind, maybe the bar stools that you wanted to have or things like that, or the lawnmower, and you're paying that outside of closing, and you would bring a check to pay for that then. So those are the most things that you'd bring to closing. Any questions on any of that so far? Okay. The only other thing I think I didn't really touch on was the earnest money. So in order for a contract to be binding, you have to have what's called consideration. So that means you have to put money down with your offer. And again, it comes back to what I touched on earlier, which is people think I don't need any money at all to buy a home. So you do need to pay for your home inspection up front, sometimes your appraisal up front if it's not enough room in your closing costs, and then you also have to put earnest money down. Now, you put money down with the offer, and then you put the rest of it down with your purchase and sales agreement. So let's talk about that for a minute. So as a buyer's agent, I try to put as little money down as I can, because if anything goes wrong with the deal, you don't have that much exposure. So usually maybe just $500 down, sometimes $100, but it's hard to get away with that nowadays. But say $500 with the offer, and then maybe another $2,000 or another $1,500 or $1,000 with a purchase and sales agreement about 2.5 weeks later. Sometimes a seller will say, you know what, I'm not taking my house off the market for $1,500. You have to put more money down. Now that gets credited back to you at the closing. So it's not money that you're giving away extra. It's just going to all go into the pot, so for example, let's say that you negotiated $5,000 in closing costs and you had $2,000 in escrow. So you have a total of $7,000 in the deal. So that will all go credited back to pay the closing costs. If you only needed $5,000 in closing costs, the VA would give you your escrow money back in the form of a check.
So you're just showing your willingness to
It's
go
exactly correct. And it gives the seller some confidence, because they think you have quote unquote skin in the game and you're not going to just decide to walk away from the house.
forward. Like you said, that all ends up back in.
It all ends up back, exactly right, yeah. So that's where the earnest money comes in. It's also called escrow. And that is held by the seller's agent in a special escrow account. And it can only be used, they can't commingle funds, it's just for that purpose. So that was about escrow. Any questions on any of that?
Well, I have one in general. It's going to
Yeah.
sound very naive because I have no idea. It's just like,
No, go ahead.
how early do you go for pre-approval for when you start looking for houses, or do you look for a while, kind of decide, I really want to do this?
No, well, thanks to the magic of the internet, you can browse all day long and look at what houses cost and stuff, right, without any obligation. But pre-approval is usually good for about 90 days. So once you get serious about home buying, and then they'll just pull it again later on, but
It's
they'll.
like we're looking to buy probably early next year.
Right.
You know what I mean? Like this time next
Yeah,
year.
so you
So
would
like
wanna
we
get-
don't need to be
you-
going and getting
you would-
pre-approved
I would
like
not,
this
no,
year.
I would
Like
not
okay.
even bother. I would just spend all this time working on your credit if you need to, making sure the higher your credit score, the lower your interest is going to be. So that's how I would spend my time. And then about 90 days, when you're getting ready to get serious, then you want to have your credit pulled and make sure there aren't any surprises on it. Sometimes there's things on your credit, but you're monitoring, so you probably wouldn't have any surprises. But somebody, average person might not know something's on there. And sometimes there's mistakes on there. Sometimes something's on there that shouldn't be,
Those surprises, just work to do.
Right.
So that's something that you let your agent, though, will pull that for, or
Your lender will
your lender
pull
will
pull the credit report for you. That's right. Yeah, they will. And
fix
then-
the things you need to, and then,
Mhm.
okay.
Yeah, and then there's different credit repair programs for people. If they need credit repair, sometimes that has to be done first, and it can take 6 months to a year to get your credit score where it needs to be. But a good credit repair company can get things taken off a lot more quickly. You pay them a certain monthly fee for doing it for you, but it really accelerates the process.
So now they say with the VA loan, it's qualifies up to $418,000. Right?
That's right.
That's what the VA loan says,
Right.
and you have to have at least a 620 to qualify.
That's right.
The amount that you can get qualified for, so it says up to $418,000. The guy that goes to them with the 620 credit score is not going to get qualified for $418,000.
It's going to depend on your income.
Okay.
If you can afford a payment on that kind of a house, then you can get it, yes.
Even with a 620.
You might not have the best interest rate, though.
Yeah.
Right? Yeah. So.
Now, how does that factor in? So, like, we will be getting married.
Okay,
She has a
you-
far better credit score than I do. I do not have a bad credit score, but she has a far better credit
You
score.
cannot use a VA loan unless you're married. In other words, she can't be on there unless you are married. So you can't use her credit score. She can be on the deed, but she can't be on the mortgage unless you're married.
So it would
my-
have to be on my own.
That's correct.
But when we are married, though, it will be, my credit score will be considered in the process.
No, well, yes. If you before you buy, correct. Yes, if you get married before you buy, then yes. If you want to, what they'll do is they'll take the best one. Sometimes one's stronger than the other, and they'll go with who has the best credit score.
So but that would not apply. So say if we wanted to buy early next year and we're not getting married until August of next year.
Right.
So we're
Then it would be
kinda-
stalling on your credit score. Yeah, and your income. That I think is.
I'm not worried about the income. I'm worried about the credit score.
Right. Yeah. Okay. So that's how that works.
At the very beginning, you said that the VA won't pay for a home that's on a privately owned
A private road.
road?
There
So if
are
it's in-
exceptions, but they're hard to get.
Well, if it's a house in, like a cul-de-sac, say there's like 20 homes in this cul-de-sac,
Yeah.
and they have an association
That's
that you
different.
pay
That's different.
into, because that's gonna do the.
Right, because that's a very good question. The reason it's different is that the association has a written ongoing maintenance agreement, and that's what it turns on. An association has that written into their bylaws or whatever, their master deeds or what have you, their rules and regs. It all lays out who takes care of the road.
So you would have to bring that to a copy of that?
Well, if you were to buy a condo, there's documents that they need anyway. There's condos that have to do, documents that are specific to condos, like the master deed, the rules and regs, the 6D showing that the home association, well, that's actually, I'm sorry, I take that back. That's on the seller side, I take that back. But they're still going to want to see what those documents are. The 6D is on the seller side, it has to be paid up. But yeah, as long as there's a written agreement on how a road is maintained, then they don't care. That's all again, it's about protecting you and your interests. So, yeah. The VA will give waivers occasionally on things, but they don't like to do it, and it's very hard, and hanging your hat on it is risky. So you're better off trying to find knowing this up front and focusing on homes that don't have those kinds of issues. Yeah, go ahead.
Now, is there anything that is different between building a house or a brand new house as to a house that's already been lived into?
Right, yep, there is a difference. The VA will let you buy a new construction house. I would check on whether or not you can, they don't want you to buy raw land, I know that. So buying just a piece of land and then using a VA loan, that wouldn't work. Yeah. But I've done plenty with new construction where it's being built, or it's already mostly up, and you get to go and pick your colors and things like that. The thing about a new home is that it's like a new car. To some extent, you're paying a premium for new. Usually you're going to have a little better of a, profit margin, if you will, or make a better deal on a home that's not brand new. The nice thing about new homes is that they usually come with a 10-year builder warranty, which is nice. And of course, you're not going to do anything to it for a long time. But if you come across a home that the seller has already gone through, they've made it vinyl sided now, they've put the replacement windows in, they've redone the hardwood floors, and the heating system's been upgraded. It's not as good as new, but it's a lot more. It's close to new. You're not going to have to make a lot of repairs in the foreseeable future, unless something goes wrong. So. Yeah. Why do you want to buy a new house?
Well, see, I have a problem because mold will get me every time. And people that smoke, I can tell when I walk into their houses. So when I walk into a house, I go, And I'll ask the realtor, and some are honest and say, I don't know, but they hesitate when they answer, so they either do know or they don't want to say anything. But I can tell as I'm walking around that, all these people are smokers. So even though, like you said, they redid all the rooms, put down new carpeting, did the floors and everything else like that, to me, they're still living in there and I can still smell the smoke. So that would mean I'd still have to rip everything up and repaint and so.
It's possible. A company like a ServPro, though, can do a really deep cleaning a lot of times and really get a lot of that out. And a lot of it, too, can be trapped in what they call soft finishes. It can be trapped in the carpet, it can be trapped in the draperies and the upholstery of the chairs.
Right.
So once those are removed, then that can go a long way towards taking care of that as well. So, and a lot of people want to paint anyway, their own colors, but you're right. It's if you're sensitive to it, it's something you'd have to kind of case-by-case basis and decide, is the value of the home such that, do I like it enough, the location and where it is and everything. And that's the other thing I encourage people to do too, is to look down the road. The average amount of time people spend in a house is 5 to 7 years. And I ask them, are you going to stay in this house for the rest of your lives, or do you see yourself moving at some point? And so that's an important question, because you want to buy a house that's going to appeal to the broadest number of buyers when you go to sell it. And again, getting away from that unique home, but there are homes that, are going to have more appeal to a greater number of people than others. So bearing that in mind too, what are your long-term goals for the property?
I look at it as I don't care. That's my relative's problem, because I'm gonna stay there forever.
Yeah.
I mean, you can say that, but you never know what's
Right,
down
you
the
never
line.
know. But some people, if they get married really young and they know that this is going to be, and sometimes too for people it'd be what's called a starter home, right, versus the move-up buyer. So your starter home. And again, price ranges in Plymouth, it's really hard to find something you're going to like that's under 300. Okay, I really would plan on that. You know, you might get lucky and get maybe 289 or something like that, but you're going to be right up against the 300 mark. You can see that, right? Yeah, yeah, yeah. I know. Right. So you know that all matters. Looking at and interest rates, I don't think they're going anywhere for a while. We've got so much turmoil in the world, as we all know. You guys know more than most people because you're in the military, and you know, without the economy strengthening, and the housing sector is a huge part of the economy. And if they raise rates too quickly, then that's going to really hurt the industry. Every 1% rise in interest rate takes approximately, roughly, 10% off of your purchasing price. So if a house, if you're approved for 300 and it goes up 1%, which is a very big increase, but if it did, then you get another $30,000 off, you can buy 270. So it really, that's why today is such a great time to be buying, because you know they will go up. They have to raise them. It's not a normal interest rate. It hurts investors, people that are on fixed incomes. You know, Wall Street wants them raised. It's not healthy for them to be this low, this long, but it's great for the housing market and it's great for buyers.
How low is it right now?
You can get as low as 3.75 for a 30-year fixed mortgage. And the other thing to think about too is if you treat your 30-year fixed mortgage like a 15-year mortgage, but without the pressure of having to make that higher payment every month, you can, you know, pay off that mortgage within 15 years easily, sometimes even more. Because if you're paying down that principal faster, the interest is calculated at a lower amount and it just goes down a lot faster. So this is something to think about, putting extra money on it every month. And if you can, the best way to do it is to put a lump sum of money at the beginning of the year. So let's say you did your taxes in January and you're going to get $3,000 back. You're better off putting that whole $3,000 on it right at the beginning of the year, because then all year it's going to be calculated, your interest is calculated on that lower principal amount instead of just chipping away $100 at a month. You follow me? Yeah. So if you can, that's ideal. And best of both worlds is doing both. Throwing your tax return money at it and you know, but again, it all depends how long you're going to stay in the house. If you're only going to stay there 5 to 7 years, you've got to do the math. Does it make sense to pay it down that fast, or would it be better off reserving that cash and doing something else with it? Question is suggestions on buying a condo versus a home, a single-family home. For VA, the only challenge you have is that there are not very many condos in our area that are VA approved. They have to be VA approved. And for some reason, in our area, they're not. You know, smaller complexes definitely are not, and sometimes even the bigger ones aren't. So you have to kind of weigh that out. The other thing is that in Plymouth, there are some condos like Chapel Hill and Tideview Path in Manomet, where they're unwarrantable, meaning that you cannot get a mortgage, whether you're VA or anybody. You have to have cash because the No, Billy, not, because of the ratio of investor to owner-occupied properties. So when that gets upside down, there's too many investors in there, they consider it to be less stable, and so they won't let you get a mortgage in there. So right now, those two properties are like that. Yeah. So, but to answer your question, really, condo depends on your lifestyle, obviously, right? If you're working all the time and whatever, but at the same time, condos were more popular when houses were, you know, unaffordable and interest rates were higher. Right. Now that you can buy a single-family home for so little, you know, relatively speaking, a lot of people tend to go that route, you know. But the biggest drawback is that in our area, if you were closer to Boston, maybe you probably have a lot more selection in terms of VA approved. But down here, we just don't seem to in Plymouth area so much. Yeah. So, all you all set? Okay. Okay, good. So, well, it's been a pleasure. I'm happy to answer. If you think of anything afterwards, my card is there. I'm happy to help answer any questions for you. And feel free.
Thank you so much.
You're very welcome.
That was very interesting.
Yeah, good.